Hello everyone, this is John Cogan. I'm the CEO of Proformative, the online community for corporate finance, accounting, treasury, and related professionals. I would like to welcome everyone to today's webinar entitled Expansion into Asia-Pacific Markets, Identifying and Leveraging the Right Expansion Opportunities. International expansion done right can lead to sustainable growth and ensure the long-term success of a company, while the wrong move into the wrong market at the wrong time can derail company growth. How do companies make educated strategic decisions in understanding the legal and political, as well as the economic implications of expanding into specific Asia-Pacific markets? In today's webinar, renowned international business experts from Nair Co will discuss what companies need to know in terms of legal entity setup, profit repatriation, employment, compliance, and taxation issues when considering expansion into Asia-Pacific markets. First off, I'd like to thank Nair Co, the leader in international business expansion, for their thought leadership today, providing us with speakers and sponsorship of today's event so that we can deliver this educational webinar to our participants at no cost. So great thanks to Nair Co. Quick note on today's agenda. First, we will hear a joint presentation from our featured speakers, who I will introduce shortly. And then we will move into an interactive Q&A session where we will spend the remainder of our hour. Now, during today's presentation, we will be asking 3 CPE questions, and we've got a few housekeeping items to get to before we begin the webinar proper. So let me go ahead and jump into that. First off, welcome to Proformative. To those of you for whom this is your first exposure to Proformative, we welcome you. Proformative is the largest and fastest growing online resource for senior level corporate finance, treasury, accounting, and related professionals. We are primarily an online resource where corporate finance professionals can meet and reach one another in a peer-to-peer network, discuss subject matter issues of great import, everything from company financing to technical accounting to technology matters. It's an incredibly unique and valuable feature. We had well over 100,000 unique visitors to the site just this past month. We're growing very quickly, and any question you ask typically will get answered by a large number of senior executives very quickly. It's just a fantastic resource. All of it is completely noise-free. There's no advertising on the site. There's no selling or self-promotion in the community areas of the site. So you don't have to worry about noise. You can just come here to learn. Please check it out at proformative.com. Now, a few notes about today's event. First off, links to today's presentation and to the recording of this webinar will be sent out to all attendees within 24 hours of the event. And the presentation itself is actually already uploaded and posted at proformative.com/resources, where you can download it for free anytime. So it's already out there. To those who are here for CPE credits, as I mentioned earlier, we will be asking 3 polling questions during today's events. If you're here for CPE credit, you must answer all 3 of those questions. Even if you're not here for CPE credit, we'd love you to answer the questions. We get some interesting statistics out of these polling questions. They're not a test for comprehension. They're really about us understanding better what companies are doing related to the event of the day. So that would be international expansion for today. So please do take a moment. They're very brief and simple polling questions. Speaking of questions, we'd like this to be an interactive experience, so please do ask questions at any point today. If you take a moment to look at your GoToWebinar control panel, you'll see there's a little section there entitled Questions. Well, you can ask questions at any time, whether it's where did you say the presentation is located, or if you have a question that's on topic that you would like the speakers today to address when we're in the Q&A section. Please feel free to ask your questions at any time, and we'll do our best to get to them during today's event. And finally, you will be asked to take a short survey today regarding the webinar, and we would greatly appreciate your feedback. It is literally a 60-second or less survey. It comes at the end, so after the final polling question, which will be the second to last thing we do, will be the final polling question. The last thing we do after we shut down the event is you'll be presented with a brief survey. We greatly appreciate your giving us a minute and taking that survey. Also, at that time, if you would like to connect directly with either of today's speakers or the sponsor, you can simply check the box, and we'll make sure that we make that connection happen. We have a number of learning objectives today. I won't read each of these, but I will tell you that our goal today is to help you understand what's going on and how your company should consider entry into a number of key Asia-Pacific markets. This is highly complex. I've been a CFO many times myself, and I've had subsidiaries in Southeast Asia and across Asia. At many of those companies, it's incredibly difficult, complex. You definitely want to have great help by your side. And I'm very much looking forward to hearing from our speakers today who have great insight into this process. So without further ado, what I'd like to do is introduce our first speaker. Our first speaker today is Venkatesh Eswaran, who is Senior Vice President, Global Services at Nair Co. Venkat heads the Global Services Operations of Nair Co. and oversees the delivery of all client services. Venkat is an expert on India inward investment and works with a variety of PE and VC firms in addition to multinational companies of varying size on that very topic. He's a qualified Indian chartered accountant and tax expert and has more than 22 years of experience in multi-country management, accounting, and audits, and has assisted transnational organizations and leading enterprises across sectors on regulatory, tax, financial, and business advisory related matters. I can hardly think of a more qualified person to speak to today's topic. So with that, Venkat, please do take it away.
Thank you very much, John, and good morning, everyone. In the coming slide, I'll briefly walk you over the current and emerging market conditions in the key Asia-Pacific economies. Have the APEC countries been hit by a slowdown? The answer is yes. They have been hit by a slowdown. The rate of growth is not as it was the last year, because the rate of growth last year was almost double-digit for China, whereas currently it's 7.5%. But still, it's quite high as compared to the rate of growth in United States and the Western world. Like the U.S. economy grew only by 2.5% in the second quarter as compared to 7.5% of rate of growth in China, or say 5% rate of growth by Singapore. But still, Asia-Pacific region is the world's growth engine currently, and 70% of the world growth over the coming years would come from Asia-Pacific, with India and China accounting for 40% of the growth. Some of the fastest growing APEC economies are China, Philippines, Indonesia, and Thailand. With China is 7.8%, Philippines 6.8%, Indonesia 6.2%, and Thailand 6.5%. Many countries are working. The approximate population of the APEC region is about 4.3 billion people, and APEC is experiencing a youth bulge. By youth bulge, I mean the percentage of youth population as compared to the working population is quite high in the APEC countries as compared to the Western world. To give you an example, the youth population is 18.2% in India, 16.1% in China, and in the US it's 13.8%. This youth population actually brings along with it high disposable income in the hands of the young people, which becomes a key driver for domestic consumption and also a key driver for growth. Many countries in this region are introducing easier and business-friendly tax laws and regulations so that they can get more foreign investments. India has recently revised its company law and is working to implement the new income tax code, and a GST regime is going to come, which is going to replace the existing service tax. China has implemented a VAT pilot scheme, which is going to replace the business tax which it currently has, and that's going to cover research and development and technology services, information technology, culture creative services, and it's going to create, the China-wide pilot scheme is going to create two taxpayers, the general VAT taxpayers, which are VAT payers providing pilot services with a turnover of 814,200 or more, and small-scale VAT taxpayers who are having an annual turnover of less than 814,200. Philippines is trying to revise its entity setup process and make almost a single window clearance, and combining about 5 government agencies like the Department of Trade, Bureau of Internal Revenue Service, Home Development, Mutual Fund, Philippines Health Corporation, all into one window. This will actually expedite the registration process in Philippines by a few weeks. Vietnam has recently reduced the corporate tax from 22% to 20% in cases where companies are having full-time employees less than 200 and an annual revenue of up to 946,000. Malaysia has recently introduced a proposal to introduce a GST system which will replace the existing sales tax and service tax system. The difference is that the GST, between the GST and the current sales tax system in Malaysia, is in the scope and also in the charge, which is more comprehensive, inclusive of manufacturing and distribution stages, as well as providing a tax credit for the GST paid inputs. Most APEC countries are also now allowing unrestricted foreign investments and simpler regulations for profit repatriation. I'm sure my colleague Anup will speak to you in more detail about profit repatriation strategies, which will help you when you are actually having operations in APEC. But China has recently introduced profit repatriation procedures, which gives a lot of document exemptions for transactions or remittances for less than 50,000 US dollars being made from China. The State Tax Bureau would not conduct any examinations or tax assessments on remittances being made, and the banks have been instructed in principle to accept the documents filed for transactions less than 50,000 per remittance. India similarly earlier had controls on the amount of royalties one could pay from an Indian entity to a foreign entity, and that was actually capped as on the, there were limits based on turnover and also on exports, but currently there are no limits, so it's primarily a commercial transaction between the two firms to determine the amount of royalty to be paid. Japan, Australia and Vietnam, there are generally no restrictions on repatriation. There's a growing talent in the APEC region. Like I mentioned before, the number of youth in the working population is quite high. They're educated and relatively available to work at a lower cost. This wage arbitrage between the APEC regions and the Western world does becomes a trigger for the growth in these regions. There are a lot of tax exemptions and government incentives being given by the countries in this region to attract foreign investment. Singapore is offering tax incentives for R&D, employment, new setups. Productivity Innovation Credit is a scheme which provides tax benefits for investments by businesses in a broad range of activities along the innovation chain. The tax benefit under the PIC will be effective from the years 2011 to 2015 for certain qualifying activities. The qualifying activities are primarily acquisition and leasing of information technology and automation equipment, training of employees, acquisition of and licensing of intellectual property rights, registration of patents, research and development activities. Malaysia is offering tax exemption for about 10 years to companies operating in Malaysia, cyber cities and cyber centers. They are also offering, Malaysia is also offering pioneer status with income tax exemption of 100% of the statutory income for a period of 10 years or investment allowance of 100% on the qualifying capital expenditure incurred within a period of 5 years to be offset against 100% of the statutory income for each year of assessment. Vietnam offers 13 years of exemptions for setting up operations of high-tech parks. It also offers 50% tax reduction in for companies transferring technology to priority sectors and operating in difficult socio-economic areas. India offers tax benefits to set up an economic for entities, enterprises set up in economic zones and backward areas for about 15 years. It's an 100% tax exemption for the first 5 years, 50% for the next 5 years, and 50% for the remaining 5 years, subject to creation and utilization of reserves. Also, there are exemptions on customs duties for units which are located in the special economic zones. But however, it applies only to new units, and you cannot, relocate a unit in other area to the special economic zone just to avail of the benefits. China levies lower taxes on high-tech sectors, 10% for software and integrated circuit enterprises as compared to the normal rate of 25%. Now, does it mean that, APAC regions are the regions to go to set up your company, since the government is so friendly and since you do have a pool of talent available? Before we all go to rush up and set up in the countries in APAC region, I just want to briefly point out the challenges there. The challenges, one of the very important challenge which you would face is increasing inflation. And when I say inflation, it also includes wage inflation. Asia Pacific employers are predicting an average of 6.2% increase in salary in 2013 as compared to 3.3% forecasted for Europe and 3% for North America. Hong Kong and Singapore employers are predicting a 4.5% increase in salaries. Salaries in Western Europe possibly would go up by about 2.8%, but 4.3% is what is actually in Eastern Europe, and employers in United States and Canada are looking at a 3% wage rise. As compared to that, the wage inflation in APEC countries, which are generally around 6% or more than that, obviously means an increase in your inputs. The slowing growth rates, global recession, recessionary trends do have an impact on APEC economies. And another challenge which you need to face when you actually operate in APEC is the bureaucracy. It's very cumbersome to deal with reams and reams of paperwork and the various layers of bureaucracy. There's also the transparency problem there, which leads to corruption. According to the CPI index, India ranks at 94, China ranks at 80, and Vietnam ranks at 123, and Philippines ranks at 108. But since APEC is a very diverse region, you do have the developed economies in APEC possibly ranking very high in this. Lack of good infrastructure is another challenge which you need to actually take into account. India does have problem of roads, infrastructure, and power. China has problem of water. Clogged roads and bottlenecks plague Jakarta's roadways in Indonesia. Philippines does need a regulatory framework to actually badly finance infrastructural improvements. But for countries like Singapore and Hong Kong, which are quite developed, the other countries do lack infrastructural requirements. There's also a scenario of weakening local currency, which obviously does a great deal of, brings a great deal of cheer to the exporters, but does have its own problems when you are actually an importer, or possibly you're a parent company located abroad and want to repatriate profits. The actual value of the money you get may possibly, though the absolute terms may be high, the actual terms in dollar terms it may be less. India actually, Indian rupee hit an all-time low of 68.85 in August 2013, as against the normal rate of about 45.50 per dollar in 2010. Malaysian ringgit fell to a 3-year low in July 2013. This obviously has got its own implications and frequently changing laws. The governments in APEC nations are known to frequently change laws, bringing it along with it compliance, which can be quite painful and costly affair. And tax authorities in most of the APEC countries like China and India could be quite aggressive and highly litigative. There's also a problem of language. Some of the countries in APEC region like China and Taiwan would want all the documents to be submitted in the local language, which brings it along with it its own set of complexities which needs to be taken care of. Along with this, I actually hand over the mic to John again. Thank you very much for listening to me.
And we'll hear from Venkat a little later as well. Thank you for that great introduction. We've got a lot more to go, but we're going to start our polling question process here with the first of 3 polling questions. We'll do the other 2 later. So this polling question: do you plan to internationalize either initially or additionally, if you're already global in to some extent, your operations? So please let us know what your plans are there, and we'll just see what folks are thinking here who are on the line. We'll leave this out for about 30 seconds, and then we'll continue on. I will use this to remind folks to please ask questions as we go. I can see a few questions queuing up already for when we get to the Q&A, but feel free to ask at any point in time, and we'll do our best to get to those in the Q&A period. Okay, looks like we've got most folks in and voted, so we're going to go ahead and close this one down, and we will introduce our next speaker. Our next speaker is Anup Pense, who is the head of R&D at Nair Co. As the head of R&D, Anup leads a team which oversees the preparation and management of the company's research templates across all service areas and the technical updates for clients. Anup has over 10 years of experience in research, taxation, foreign exchange regulations, and audits. So with that, Anup, thanks so much for joining us today, and I will let you take it away.
Thanks, John. I'll start with my section. Essentially, the section is on comparison of setup options available in Asia Pacific, and then we'll just touch base on taxation of repatriation from these countries. Now, why there is a section required essentially on entity setup in APAC region is because though Venkat has mentioned a lot of laws are becoming easier in APAC region, still setup is much difficult compared to Western countries and developed countries. A lot of government requirements are tedious and a lot of documentation is required while setting up. This presentation I have broken up into sections entity-wise, so we can compare various entities better for setup. I'll start with limited company option. Now, the key features of limited company in this region is this kind of entity is generally encouraged by government. For a simple reason, governments find it easier to monitor an incorporated entity which generally has a local director, and in some cases it requires multiple shareholders. So this is easier for government to monitor as compared to other loosely incorporated entities, which I'll touch base later on. It is most popular among foreign investors in most of the countries. Again, APAC is a big region. Many countries are there. So, I'm just generalizing it that this is generally commonly followed by foreign investors. Again, as being the APAC being a very, you can say, it has very developed countries like Singapore, Hong Kong, Australia, whereas there are many underdeveloped countries. So setup is generally easier in countries like Singapore, whereas it can be really difficult in many other countries. Now we'll just look at the cost. What can be the cost other than, of course, the professional fees and professional lawyer fees required for setups? One element I consider capital. Now this is not a cost, but if one is expanding into 5 or 6 APAC countries, there will be a lot of upfront cash flow which will happen on account of capital. The capital requirements are generally low in APAC countries, but as I mentioned, it can be very high for foreign investment and employing foreign employees. I'll take a couple of examples. Like Indonesia requires about $100,000 of capital for foreign investment. Philippines requires $200,000 of capital requirement. Indonesia even has higher requirements for certain sectors. The next element of cost, of course, is local director, which will be required. And setup costs are generally high in these countries compared to developed countries for various reasons. One is not availability of one-stop shop. What I mean by one-stop shop is all registrations being handled by one government authority. This is not there in APAC countries. Just to take example, in India, Indian government says that a company can be set up in as quickly as say 72 hours. But the issue is that once you set up the company, you have to approach tax authorities, which is different from a company setup authority. Then you have to approach labor department for labor registrations and so on and so forth. It is there in most of the Asia Pacific countries. So one has to approach various authorities, which takes a lot of time and of course the cost. The next factors I am touching is unique aspects of limited company. First and foremost is it completely or at least substantially avoids permanent establishment risk. Your holding company or the parent company will not have tax exposure in for their global worldwide income in the country, because formation of P is not likely when you are having a limited company in that country. In many countries, limited company has more credibility in the eyes of employees, in the eyes of vendors, in the eyes of customers. A prominent example can be Japan. It is always preferred in Japan to have a GK or a KK, which is the form of a limited company there, as compared to having a representative office. Next aspect is, yeah, there will be a requirement of multiple shareholders in many countries. I can think of, India, Indonesia, Malaysia. In fact, Philippines is a unique case where 5 founders are required, for setup of company. The 5 founders are required to be natural persons. That doesn't mean a foreign company cannot set up operations in Indonesia. The 5 founders will hold only single share, and the rest of the shares can be held by the parent legal entity. Still, it is a cumbersome requirement. Finding 5 single shareholders, natural shareholders, one needs to take help of local professional firm. Some of the countries have unique benefits with US. They have signed treaties with US. One is Thailand Treaty of Amity with US. Other is bilateral treaty with Vietnam. When this treaty is in place, it helps US companies to set up easily compared to investment from other countries. The setup process for companies as well as other entities can be very complex in Asia Pacific countries. Some of the things I can think of is, first is language. Most of the documents need to be translated in countries like Japan, Taiwan, China. And second important thing is that the document requirement itself is multiple. One-stop shop doesn't exist. So all the registrations have to be done at different authorities, individually at different authorities. Plus most of the documents require some kind of notarization or apostille in the parent company country. So if US company is investing in Japan, the US documents will require to be apostille, which takes a lot of time. So as I told, in India, theoretically or on paper, or in Malaysia, a setup, or even in Japan, a setup can complete in weeks' time, but preparing the documents required for the setup can take few weeks or few months even. This I already mentioned. Next point is branch. Now this is not a common form of entity in Asia Pacific region. When I go to unique aspects, I will discuss why it is not. One important point for Asia Pacific region, and this we can see in Middle East also, is a branch office also requires minimum working capital. They cannot call it share capital, they call it minimum working capital. In Thailand, it is required that the company pays about $160,000 minimum of working capital to set up even a branch. Or Taiwan has a unique proposition if you are employing a foreign employee in a branch in Taiwan, then one will require $170,000 of working capital. So that is little high. The setup cost again includes local representative, registration with other authorities. The branch will cost almost similar to that of a company because the registration requirements are almost same. Unique aspects of a branch include it can have significant fee risk because it will carry on the business for a parent company as a parent company. It will not be a separate legal entity in many of these countries. That's why the fee risk is very high. This form is not generally suitable for foreign entity investments. Like in China, there is no clarity how a branch can be set up. So generally, except for oil and gas and banking business, a branch is not set up in China. In India, it requires 5 years of profit track record. So that's very difficult, and not very difficult, but difficult for a holding company set up only for investing in India. Definitely, it is difficult. Again, in India, the tax rate exceeds 40% for a branch setup, whereas for a company, it is around between 30 to 33%. The next option is representative office, or what is called liaison office in India. This is something which most of the entities use for testing the water. Before setting up a limited liability company, many companies will like to go for a representative office. In Asia Pacific countries, one of the unique aspects is that these are generally allowed for fixed period. Singapore allows only for 3 years, renewal is required annually. Similarly, China allows it for 1 year, Vietnam gives it only for 5 years. So one needs to really analyze whether this time period is sufficient to do a liaisoning work, or it's better to go for a company setup directly. There are serious restrictions on activities. The activities allowed for representative office generally includes only market research, liaisoning work, then some kind of, the basic groundwork, finding the customers, but more. No commercial activity is allowed for representative office. If that is carried on, then you have a tremendous exposure of fee, and the government asking you to convert or close down the representative office and start a limited company. Of course, representative office has its own pluses. It's easy to set up and very low on compliances. Local representative may be required in many countries. The cost of representative office is very low. In rare instances, minimum working capital may apply. Like in case of Thailand, again, minimum working capital is required for RO. Overall, the cost will be less than companies and branch setups. Some of the unique aspects is fee risk exists, which is much lower than, of course, what is there in a branch, because the activities will be limited. No commercial activity will be carried out. That's why the permanent establishment risk is very low. As I mentioned, track record is required in many countries. In Singapore, you need to have existence for 3 years before you set up a RO. In India, you need to have a profit record for 3 years, or your minimum net worth of the parent company should be USD 50,000. That's not much. There are restrictions on having number of foreign representatives or employees itself. Like in China, you can have only 4 employees in representative office. In Singapore, you can have only 5 employees. So this is only useful for seriously low level of activity. If you want to have some serious operations in that country, this is not the option one would go for. But this is good for testing the waters. Now I'll come to the very unique kind of entity in this region, which at least to my knowledge is not there in any other region, which is called regional or operational headquarters or global trading company. These are essentially normal entities like a company, and which will have some kind of unique tax benefits attached to it. Regional operating headquarters are allowed in Malaysia, Philippines, Thailand. In Singapore, it is called global trading company, which is allowed to do some specific trading. Local representative may be required again in this particular case. The point with local representative is in some countries like India, all the directors can be foreign directors. But now the law is changing, and the new law proposes at least one director should be Indian resident, and this adds to the cost if one needs a local representative. Capital requirement will be higher for regional or operating headquarters because one needs to prove that that particular entity is actually an operating headquarters. Setup cost will be same as that of company, and the compliances will be same, because essentially the legal entity will be a company. There are some unique aspects for this. First and foremost, the operation should justify the existence of such entity. In a sense, if somebody is saying that this is a regional headquarter in Thailand, then it should act like a headquarter. It should be having multiple offices from multiple countries reporting to it. In case of Singapore, if it is a global trading company, one needs to prove to I Singapore, the authority which gives global trading company license, that the company is actually trading. It has a vast amount of experience in trading. There are tax benefits, like in Singapore, the tax for global trading company will be 5 to 10%, which is much lower than the normal Singapore tax rate for specified activities. The last item of registration is payroll registration, which is very commonly used in developed countries and Western Europe. This option really does not exist in APAC region. Maybe in Australia and some developed nations like Australia one can try it, but in other countries this is not permitted, either for legal reasons, like tax authorities may have its own questions, or foreign exchange authorities may have its own questions, and thus it is not a very recommended kind of entity. Now I'll come back to tax repatriation strategy. Again, this particular topic will require a presentation in itself, so I am just touch basing on some of the pitfalls that one is likely to face, especially in countries like Asia Pacific countries. Having thorough knowledge of local requirement is necessary. I have taken a few examples. I'll elaborate on that. A lot of people we interact with are aware that India doesn't have withholding tax on dividends. But the problem is India has a dividend distribution tax. So effectively, when you are declaring a dividend, your cost jumps up by 16.995%. It is not exactly one can say that there is a tax benefit because there is no withholding tax. Similarly, Singapore doesn't have a tax treaty with United States, which results in very high tax if repatriation happens from Singapore to US. Why I taken this example is because Singapore is a very low tax jurisdiction, but if you are transferring funds directly from Singapore to US, it's going to cost a lot. Similarly, in Australia, there is a withholding tax of 46.5% on all payments if ABN is not obtained, that is Australian business number. So one has to be careful about such tax requirements. Merely knowing tax benefit is not enough. I have taken example, limited liability partnership in India doesn't have a dividend distribution tax, whereas a limited company has it. That doesn't mean LLP is a better investment option, because setting up of LLP requires government approval, which may or may not come and can take weeks or months. So essentially LLP may not be feasible compared to LLC in India. Similarly, there are requirements to create reserves before declaring dividends in China and India. These are the company law requirements. In China, one needs to have 10% of profit transferred to reserves. In India, it can vary from 2.5 to 10% of profit to reserves before declaring dividend. Next point I am covering is documentation requirements. As I have listed out, there are numerous documentation requirements in these countries. In China itself, we will require at least one extra presentation of 1 hour to discuss all the documentation requirements before repatriation. But the good news is, as Venkat has mentioned, recently the regulations have been relaxed. Up to $50,000 remittance will not require documents now. Essentially, this is not exactly a good news, because now you need to register with local tax authorities and your dividend repatriation is not verified by the tax authorities. So if you are wrong about the withholding tax, then you may end up paying penalty. Yeah, as I have covered, there will be other taxes which will be important to know, like there is a business tax in China which is getting replaced by VAT pilot scheme, which applies on royalties and fees for technical services. It increases the cost of royalties and fees, so maybe dividend may be a better option to repatriate. Similarly, as Venkat has taken recently, withholding tax on royalties and fees for technical services has gone up in India. And similarly, there are service tax in Malaysia as well as India, which may add to your cost. With this, I wind up my section and I hand it over to John. Thank you very much for listening to me.
Thank you, Anup. That was fantastic. A lot of great information. It's dizzying. how much one needs to know in order to effectively approach these challenges and be set up in these countries. So great information. I've already launched the second of our 3 polling questions. The third will come at the very tail end of this morning's webinar. So we'll go ahead and give folks another 15 or 20 seconds to weigh in on this question. I'll also remind folks that at the end of today's webinar, when we close everything down, you will be presented with a brief survey, and we would greatly appreciate your giving us that final minute to take that survey. Okay, I'm going to give you 5 more seconds on this poll, and then we'll get into the last section of the presentation, and then we will head into Q&A. So I'm going to go ahead and close the poll down right now. We will jump back to the slide deck. Venkat is going to go ahead and take us home now for the remainder of the presentation up to the Q&A. So Venkat, please take it away.
Thank you very much, John, and welcome back, everyone. As I said, there are no unions or work council for white-collar employees. High registration requirements are generally required, and they are not centralized, so you got to have registrations with local authorities, which is quite cumbersome. And data protection regulations exist only in a few countries, that is Singapore, Malaysia, Philippines, and in Singapore also it's going to be employed in a phased manner and less stringent as compared to the EU. Requirement relating to fair trade policies, which are quite obvious in Western Europe, is very not visible in APEC countries. I'm going by the key unique features by the country. China actually has introduced a new labor law which restricts employers' use of employees on secondment and an approval from the labor authorities required for hiring a foreigner. India has got various registrations which has to be done at the local municipal level, and and the requirements also vary from state to state. Australia, in Australia, a foreign employer can be employed only when you are able to demonstrate to the authorities that there is no local talent available and the person whom you're going to be employing is not going to be paid less than what you would have paid a local employee. Similarly, Malaysia and Taiwan discourage entities incorporated in Malaysia and Taiwan employing foreigners by introducing very high capital requirements for the entities which employ foreigners. Like Malaysia, to give you an example, Malaysia has got a requirement of $152,000 US for a foreign ownership, and Taiwan has got, if you hire a foreign employee, $168,000 as the capital requirement. Obviously, if it's a branch and the person who is going to be employed is a foreigner, but he's a branch manager, then this requirement may not apply. Vietnam has got companies hiring foreign employees to have a training agenda for the locals. The idea is they need to ensure that the training is done for the local employees so the local guys have the talent. Foreign employee permit duration is also reduced to 2 years in Vietnam. I'll go through the brief features of Social Security and tax. Social Security and rates and thresholds are generally lower in APEC countries as compared to Europe. Withholding tax requirements can be very stringent and litigated, especially in India. Many countries have only 1 or 2 components of Social Security as compared to Europe, where there are quite extensive components of Social Security. Social Security can be very low for expats in some countries in APEC. In India, the Social Security contributions are quite low, but can be quite high for expats. Because for expats they are not capped, whereas for locals they are capped. In South Korea, you have withholding tax requirements triggered in case if the individual is paid from the entity locally incorporated, whereas if he is an employer who is overseas, then there is no withholding tax requirement. China has got some of the highest Social Security rates in the entire APEC region. and it also varies from province to province. I'll also briefly walk you through the retrenchment procedures. It's easier in APEC countries vis-a-vis the European countries for white-collar employees to be retrenched. Retrenchment process differs widely across the region. Cost of retrenchment needs to be carefully ascertained, and retirement age varies fast. It's easier for white-collar employees. In Japan, termination is not very common, and usually the employer speaks to the employee and gets him terminated voluntarily, whereas he resigns voluntarily. And in Vietnam, there has been a new labor code introduced, which also brings into account the various rules which need to be done in the employment. The other salient features are labor laws being frequently changed alongside growth creates its own sets of problems. Regulations relating to fair work, anti-discrimination, health and safety are being introduced as the APEC gets integrated with the world economy. Many countries do not have well-evolved laws of court judgment or precedents for non-compete, non-disclosure clauses, IP clauses. Benefits relating to maternity and paternity leave are increasing. Immigration rules and processes are evolving for foreign employees in many countries. The key features by the countries, the privacy and data protection legislation have been recently introduced in Philippines, Singapore, China. We have already mentioned that. South Korea has got a very interesting regulation where an employee inventor initially owns a work for hire invention. This is something which is very unique to South Korea. You need to ensure that you have appropriate clauses in the employment contract to ensure that he assigns any invention he does during the course of his employment to the employer, or else the employer will lose the right. New legislation is also being undertaken in South Korea against age discrimination. Vietnam has got introduced a new labor code which we already went over. Non-compete agreements in India are generally void. IP-related clauses are not commonly understood in India. I would just skim through the last slide, which is the common pitfalls, to ensure that we have some time for the Q&A session. The common pitfalls while expanding to Asia Pacific, as Anup mentioned, is not knowing the federal tax itself as rates is not enough. You've got to know also the rates like the service tax and the VAT and other taxes which come along. Never ignore compliance and litigation cost. Other tax benefits and exemptions while repatriating automatic. Do not make the mistake of considering the exemptions to be automatic. There could be rules. They could be subject to terms and conditions. You need to ensure that you fulfill that. Is it easy to pay taxes and be compliant in the chosen country? Since APEC covers a wide number of countries from Australia, Hong Kong, Singapore, Malaysia, so obviously you need to decide which particular location has to be done, and that has to be done by taking into account various parameters which can affect the overall cost. You got to also ensure your documentations are accurate so that you do not lose any benefits like tax residency certificates and any tax-related documents, so that, and you got to be on guard for special anti-avoidance provisions like CFC, GAR, and transfer pricing, which if you do not keep into account, be very fatal for you and could be a result in penalties or losing of exemptions. Constant changes to law, wrong choice of joint venture partners or wrong hire at the top level could do immense damage. Underestimating the bureaucracy, considering the area as one market, compliance requirement, uncertain tax, political and judicial environment where you find the laws constantly being changing, and also, as I said, the bureaucracy. All this add to challenges which you got to watch out for. Thank you very much for listening to me, and I'm happy to take any questions which are coming.
Okay, wow. Well, that was a lot of content. I'll take this moment to remind folks that a recording of this presentation will be available. Usually it takes us about 48 hours to get them up on the site. Also, yeah, the deck, of course, is already available, as I mentioned earlier. We've got time for a couple of quick questions. We'll do a first one. to Anup. There are a lot of instances where there's a minimum working capital or minimum investment requirement. Now the question is, does that mean the company must drop that amount of money into a bank account in the country, or does it mean that you have to purchase that amount of services in the country or pay your employees that amount on an annual basis? What does that minimum mean? Is it a one-timer or an ongoing sort of expense?
See, I would like to tell you that this working capital has to go in the bank account. It can be decided by a company freely how they want to spend it. So this is not something which is going. The money is not going. Why I mentioned this point basically is because if you are expanding, we normally see this problem happening with the companies. If they are expanding in 10 countries, upfront they require a lot of cash flow. So it is going to go to the bank account. It's not required that it has to be spent in a particular way. The company can decide the way they want to spend it.
Got it. Great. Venkat, do you frequently see customers going directly to the country they want to serve to create their legal entity and serve that country, or do you see folks, let's say someone wants to do business in China, but they want to be based out of South Korea, and therefore they'll serve their China customers via South Korea? Is it common to go through another country because the corporate setup is more convenient or makes more sense for you, or would they typically go directly to the company to the country that they are wishing to serve?
It depends on, I'm going to say, both the things which you said are seen by us. Like, we have seen companies directly entering into countries also, and we have also seen cases where people try to have a hub somewhere else as a holding company, like Hong Kong could be the holding company to enter China because, you know, of the tax treaty which Hong Kong has with several countries, so that, you know, any profit being made in China is routed to the Hong Kong entity and then, you know, spread out from the Hong Kong entity to the parent entity. So it actually depends on the case and what they intend to do, and that would be the way you are going to go. We have seen both the cases.
Okay, and a final question related actually to our last one. How do people usually get started? Obviously, they could talk to folks like you at Nair Co, but do people commonly go to their law firm first, to their accounting firm first? Where do, where's the logical place for most folks to get started?
Actually, I think the logical place generally people do go to is the law firm to get themselves set up. And then they are going to go to an accounting firm to get their accounts sorted. So the law firm is the normal place to go to get themselves set up.
Okay, great. All right.
But of course,
I'm sorry, what was that, Venkat?
No, at Nair Company, we actually help with all the services all together, because we have a lot of experience setting in multi-countries, at single point of time, or it can be one country at one point of time. Whenever we require, we take, help locally.
Got it. Great. Okay, a couple last notes, and then we'll launch the final polling question. You will be prompted to take a short survey after the event, so just a reminder there. You can certainly continue this conversation at Proformative.com. We actually already have a lot of conversations about companies going global there, and it's all, as mentioned before, peer-to-peer. If you have any questions about CPE credit, simply email cpe@Proformative.com. We'll get those taken care of. A special thanks to our two speakers today. Fantastic job, Anup and Venkat, and of course to our sponsor, Nair Co. Thanks, gentlemen. Well done.
Thank you very much.
Thanks. Thank you.
Finally, on to our last polling question. We'll go ahead and launch this, and we'll give 30 seconds to give an answer to this question, and then we will close down the webinar. So we do appreciate the time and attention of everyone today. We apologize that we had that 2 minutes worth of telephone issue there. I'm glad we got that straightened out so it didn't get us too far off track. We greatly appreciate you giving us your time today, and we hope to see you again at Proformative.com or at another Proformative event. I'll go ahead and close down this last polling question now. Thanks so much, everyone. I will, at this point, shut down the webinar and you'll be taken directly to the survey, which will take 1 minute. Thanks all. Have a great week. Take care.